back to Market on Close here at Schwab's Impact Conference in Philadelphia. To my left, I have Kathy Jones and Randy Frederick to talk some big picture as we head into the closing bell here, and stocks are limping into the finish. Kathy's the Chief Fixed Income Strategist, and Randy's Managing Director of Trading and Derivatives. Great to see you guys in person.
You bet.
Here in Philly. Stocks are getting hammered right now. The Nasdaq down 2.5%. We talked to Katie Stockton about some of the levels that she argues we're still testing, but you look at this from a little bit of a bearish lens, Randy, and you could see some breakage happening here.
Yeah, I was pretty encouraged by the S&P sort of holding support there at that 200-day SMA. It's a simple moving average.
Yep.
It's maybe not going to happen. It could very well break down below that. If it does, unfortunately, the next stop is probably a 10% correction line, which is not real encouraging.
That is a huge point, and I couldn't agree with you more, because there was so much trading basically in late May after NVIDIA's pop.
Yeah.
We took that 10% move fast. So is that kind of where you're getting that kind of crevice that might be in the market we could slip into?
Yeah, a little bit of that. And I think, a lot of it has to do with earnings, right? I mean, the big magnificent seven, we've had some divergences, right? I mean, Microsoft did well. Google, unfortunately, did not. We got a few others coming up. So if the mega cap's not holding up the market, the rest of the market's not going to follow in all likelihood, at least not in the near term.
So right now we've got some of these big caps kind of bouncing off each other, but net a little bit negative. But to your point, there's some winners in there too. And just in the last 10 days, some of these companies are making 52-week highs. What about in bonds, Kathy? Is there a two-way trade, or is it just like, buckle up, we're going for a ride?
Well, it's been sort of a ping pong ball lately, especially its 10-year. We've got 20 basis points in either direction. I think we're not done with this whole sell-off in the bond market. I don't know, when it ends or at what exact point it ends. I think we're near the end, but there's still, you still have buyers stepping back and saying, I'm just going to wait till the air clears, right? We've got a Fed meeting coming up. We've got employment data coming up. We've got the PCE coming up later this week. I think people are just standing back trying to figure it out.
How important is it that what we've been getting in bonds has not caused a big move up in the Fed funds expectations? Is that a game that's going to be a catch-up game where all of a sudden we are going to start to see the 2-year moving fast again? Are we going to lose any of the steepening? Because it seems like at least right now we are still getting the steepening, which should be at least more encouraging than a year ago.
Right. So 2 years really going to just depend on growth expectations. So, I think most of this move up has been adjusting to the fact that third quarter GDP is going to be 4% to 5%, right? And that means the Fed's higher for longer than had been anticipated. So until we get signs that growth is slowing down, that shifts the expectation for the Fed. I don't think we're going to see 2 years boiling up a lot higher unless we get another growth surprise in the fourth quarter. Seems unlikely, but...
What would constitute a surprise for you tomorrow for GDP?
Well, if it's above 5%, that would certainly shock a lot of people. But we have a lot of people in the 4.5% to 5% area for their GDP.
I think 4.5 is about the expectation.
Yeah,
that's what I thought.
So we have a lot of people bumping up against that level.
Atlanta Fed too, even higher, right? Like pushing, but that's the Atlanta
They're
Fed.
always way up there, though.
The thing that seems like the problem for stocks, Randy, is that the bond move, what's great about the bond market is we look and we see yield going up, but the causes are completely different from a year ago. So there's a distinction. Steepening versus flattening couldn't be more different. But it's like stocks are just going up, yield up, bad for us. And what does that mean? Does that mean stocks are just too expensive or what?
Well, I mean, anytime you've got a viable alternative to getting a 4 or 5% yield to equities, then all of a sudden you hold them to maturity, you get back 100%. You can't always count on that anytime you buy a stock. So
it doesn't matter why they go up, they reach that level.
It doesn't matter why they go up, but they're just a viable alternative. And when that happens, then it makes equities a lot less attractive. And certainly any growth stocks, any new companies that have debt they got to roll over, it's going to be problematic down the road.
Kind of thinking about where we are here with advisors, as we talked earlier with the team at Baird about Marilyn Stanek, about how the bar right now for equity products is very high, right? Because not only do you have to hit 5%, but given the risk you're going to be associating with it, given that, as she was pointing out, you get a tax-free muni for 8%. What does an equity investor then do to kind of get that extra oomph? Does it come from the options market? Do you see products that capture yield that way?
Well, for an equity investor, I feel like they need to add more bonds, to be quite honest with you, because unless you expect rates are going to continue to go higher, at some point those rates are going to come down, and when they do, that bond portion of your portfolio, there's a lot of talk this year about bonds not doing well for you, but if you buy them when they're not doing well for you, that means the good times are in the future. So I know an equity investor doesn't want to hear that, but sometimes I think that's the right move.
Wow. What about bond-like stocks? Is that a real thing, or is that
bond-like stock?
Yeah. Reaching for yield and the kind of classic dividend-paying type stuff, does that work?
Well, I mean, there are certainly there are stocks in the utility sector and in the staples area that are paying dividend yields that are comparable to what the bonds are paying, but there's still a lot of price risk, and some of them haven't really performed that well. We're in a pretty cyclical period right now, and those types of stocks have actually underperformed here lately. So they got driven up in price a lot previously when they were really the only alternative because bonds weren't paying anything. Now that you can get something out of bonds, unfortunately, they haven't done as well since.
That's a great point as well. Randy Frederick and Kathy Jones, fantastic convo. Thanks a lot.